Sorry, I
Right.
forgot to record.
Yeah.
It's recording now.
Yep. So the thing is with this whole COVID thing, there's a lot of conflicting, I guess, opinions. So you've got some economists saying that property prices are going to drop by the end of the year. You've got others saying that it's not. You've got others saying it's going to be even better. And then you've got some banks, they're forecasting as well. They're saying that it will drop by 2023. Some are saying 2022. So it is a very confusing question, to be honest. I thought I'd just take a step back, and because this is more educational, I do want to make you guys think about this more. Is not so much look at that particular question, but just look at other things that have happened in the past and things that we as a company are looking for when we select locations. Okay, so nothing here is based on anything I say here is based on what we believe. Again, what I do want to show is some facts, some figures for you guys, also for you guys to objectively think about it as well. And that's what it's all about. Two-way communication between you guys and us. And feedback is always very, very good for us. We love feedback, but today's question, what will happen to the property market? Well, let's have a look. Okay, so the first thing I want to show everyone is, hang on a sec, let me just change this. First thing I want to show everyone is what the national median house prices have been since 1996. So that goes back, what, nearly 25 years ago, right? Or 26 years ago. Now, the reason why this is relevant, because there's obviously a lot of the questions about COVID, but if you see here, guys, I've put here all the stages where all these, experts or so-called experts or economists and banks have said that property prices are going to suffer. And obviously there's a lot more events that happened, but these were the main events that we saw a lot of media and a lot of people coming out saying, be careful about property prices. Some were saying, dropping at 40%. So if we go back in time, all the way back to 1996, these were the main sort of catalysts for not only the media, but the catalyst for people to start speculating about the market. Okay, start seeing, their reviews and their comments about you shouldn't go buy, this is not the right time. For me, that's all very speculative. Okay, so the question really is, when we look at this, is what does this actually show that from 1996, when the median house price was going to be probably about 150,000, who would have thought 25 years ago, if you asked someone 25 years ago that it's now, 800,000, nearly 800,000, they probably may not have believed you. Okay. If you ask someone 25 years ago, the median house price in Sydney was going to be 1.4 million, they may not have believed you either. Okay. But this just shows that throughout this cycle, things happen. Throughout a time frame of property, it happens. And things are sometimes out of our control. Okay. What this has taught a lot of investors who have invested for a very long time is investment is like a marathon, not a sprint. And this is where a lot of people, I believe, view it. And it's a really good analogy, marathon. I use it a lot, and I try to educate people about it because it's the same sort of thinking. Okay, for example, in a marathon, it's a very long race, and it's just like the journey of property. You have a start and a finish, but in between, there's going to be sprints. There's going to be, you'll slow down. There's going to be things where you need a break. But in the end, it's all about you have to begin and then focus on the finish line, just like property. So those people who have bought longer, hoping that property will change, their focus was just about, if I buy a property now, we're not looking to try to gain, 100, 200,000 in 1 year. What they're looking to do, successful investors, is looking at a minimum of a 15 or 20 year period. Okay, so just focus on that finish line. Now, imagine this now, guys. So now that you know a little bit of this chart, just put yourself back in all these different scenarios. So as an example, if you bought a property, when they changed the superannuation laws, that was a big thing back in 2006. And that's when people said, oh, because of that change, it's going to affect the property price. So imagine if you did that, then, 3 years later, you might have bought during the GFC. Okay. So these are two major economic, I guess, catastrophes that people were saying. And then maybe later on you buy back in 2013, and then you buy when Europe had negative interest rates. Again, that was a big thing about property, and you bought that in 2015. Okay, the question is, if you had done this scenario, what would your outlook have been today? Okay, so I look at this and say, to get, for example, 4 properties, and I have paced it out in a way where you're buying a property almost every 3 years. Okay, so from 2006 up to 2015, all right, 9 to 10 years to get, say, 4 properties. Okay, if you can pace yourself to be able to do that, just like a marathon, and not having to think about all these changes that happen throughout life and throughout the economy, you probably say, if you did this, your property is probably, or your entire portfolio probably has doubled by now. Okay, even with all of these things that happen. Okay, so I just want to preface this a presentation to have that mindset from the beginning. Okay, so now we come back to, how will the current lockdown affect our future property market? Because that's the question everyone asks. Well, before we can get to what the future is, let's just first look at how it actually affected it now. I think that's much more relevant before we get into the future. So here's an example. So this is the change in property price since 2016. Okay, as Bruce mentioned from the beginning, when he said that, who would have thought that COVID would have equaled the biggest house price upswing in the last 30 years? Well, it has. House prices are rising now at the fastest pace it's been in 32 years because listings can't keep up with demand. Okay, that's what CoreLogic, and that is actually true. So just look at this, guys, that for both houses and units nationally. Now, before I get to say, when I say nationally, just remember again, guys, there is no one market. So when people say a property market, that's just, just talk about a market. There's always a market within a market, which means an area's specific areas perform differently and suburbs perform differently, and the type of property you buy in the suburb also performs differently. Okay, but on a high level, on a national level, you've seen that houses since 2020, when COVID hit, in this period and up to today has gone, 17, 18%, and units have gone 7%. And here's a breakdown, guys, of Sydney, Melbourne, Brisbane, Adelaide. All of them, both houses and units nationally, have gone up. Now, that is something we haven't seen. Okay, that's something in the last 32 years where every state and every property type has seen some sort of increase. That's quite unheard of. Okay, so just remember that what has happened since the start of COVID is we've seen these prices now grow at the fastest pace. Okay, how did this happen though? That's the question. Because once we understand how it happens, we can understand possibly how the future can happen. So how did this happen? Well, firstly, let's go back 1 year when, again, the economists and the property experts, let the bloodbath begin. They were saying last year that house prices in Sydney and Melbourne could halve in the worst crash since 1890s. Okay, again, media. This is the media saying all this, but it actually did the total opposite. Okay. However, in saying that, these were the reasons why such a pessimistic view and forecast was there. Number one, they said it's because of slowdown in population, right? The prediction was rise in unemployment. Because there's going to be a rise in unemployment, there's going to be mortgage defaults. That means people won't be able to pay their mortgage. So we're going to be in arrears. That will cause fire selling, which means because they can't pay their mortgage, they're forced to sell. And because of the population slow down, it's also going to slow down demand. And if you combine all that, yeah, that's very pessimistic. That seems like everything's going to crash. If you combine all of that together, then obviously a prediction of a crash is probably there. Okay, but let's actually look at it now objectively for a second. Let's just look at the unemployment rate when they talk about unemployment rate. Okay, so I'm going back now from 1984, right? Today in 2021, we're sitting at about 4.5% unemployment rate. Okay, if we go back to 1992 and 1997, where Australia had its highest unemployment rate, we're talking about 11% and 9% at that time. That's double than what we're seeing today. Okay, at the peak of COVID, it was at about 2020. We look at this, probably close to 8%, 7.5%, when businesses were kind of forced to shut down, right? But let's go back now and say during that period, Australia had, remember, the biggest boom it had in 32 years, even at an unemployment rate of 7.5%. Okay, so keep that in the back of your mind. The question I ask is, at the highest point of unemployment rate, 1992 and 1997, the question is, would you guys have invested? Okay, remember, we're going back to that chart, this one, where, in 1996, it was 150,000. 1992 would have been even less than that. Okay, so imagine this whole unemployment rate, what people are saying, and this is going to cause some sort of property crash, is the question is, if you had bought a house back in 1997 at the highest unemployment rate, and on top of that, you've got the Asian financial crisis at the same time. Okay, now I know, like my parents, for example, if I had asked them today and said, would you have bought in 1997 more properties than you actually did, I'm pretty sure they would say yes. So
I just activated a poll. All right, so literally I just asked a question: would you have invested in 1992 or 1997? Yes or no. So there's a poll running right now, and I'll let you know what the answer is in a little bit, John.
Yeah. And
you
know what, guys, I put this up here just to get you guys thinking about what media says, and all these unemployment rates. I understand for businesses it's tough, but for property, how does it really affect it? And if you just look at the history of property and you look at this graph, you can see that if you had bought a property in 1997 for 150,000, it's probably worth 4 times it is today, maybe even more. And that's during two big catastrophes, they call it, which is Asian financial crisis plus high unemployment rate, right? So the next thing I want to talk about is what everyone was saying was about mortgage arrears and negative equity. So negative equity means your property is worth less than what you owe. Okay, so as an example, your property is worth 500,000, but you owe 600,000. That's what a lot of fear last year was about. People are going to be in negative equity. Well, let's actually look at what it is today. So the latest one we can find is late last year. It comes out yearly. So this September, the next one will come out. But let's look at September 2020 last year. Australia's negative equity is 0.1%. Think about this for a second, guys. 0.1%, and majority of that is because of Western Australia. Okay, so more people in negative equity lives in WA, and that's because of what happened during the mining boom, when people were buying properties because there was this big mining boom, and everyone was rushing to Western Australia, and then when the mining finished, everyone went back to their capital city, and that created that negative equity. And this is also what we call share of loan balances in 90-day arrears. So to be classified as you are in arrears, which means you can't pay your mortgage, you have to at least be 90 days. And we are sitting at 0.1%. Okay, so think about that now, guys. We're sitting at 0.1% negative equity. Our unemployment rate right now is 4.5%. Okay. And just remember, we are still sitting at a very low interest rate, which is allowing a lot of people, even if they were affected by their job, because the interest rate is so low, it's still allowing them to help pay their mortgage. Okay. So that's on the negative equity. Now, this is the big one, which is population. Okay. So yes, it did slow down, and it slowed down drastically. Okay. So if you look at this from 1980 all the way to 2021, which is here, huge dip in population. And that's because it's about the net overseas migration. Okay, so since 2010, Australia has averaged about 230,000 new migrants per year. Okay, since about 2010. And then obviously when COVID hit, borders shut, and there was a big slowdown in population. So that is justified, and that's true. It did happen. So population slowdown happened there. Now, however, here's what people didn't really realize, and I don't think anyone could have predicted it. 500,000 expats also came back to Australia. Okay. So what that means is people who are Australian citizens or permanent residents who are working outside of Australia also either had to come back or wanted to come back. And there was 500,000 people. And that's just from the start of this year. Okay. It's probably even more now, and there's still more people coming. So again, have a think about that, because that equals 2 years of migration. Okay, so remember that we're getting about 200,000, 230,000 a year. And then all of a sudden in 1 year, you get 500,000 people come back. And bear in mind, guys, they're coming back, not coming back because they're forced because they lost their job. They're coming back to Australia, but still having that job because they can work from home. Okay, so now we're trying to unravel how this whole boom happened during COVID. Okay, then what happens is once those people come back here, you can see it in the data, the buyer demand index. So you can see it that as soon as that happened, buyer demand is actually the highest it's been even for the last, I think, 10 years. You can see in 2019 that the average demand was about 100 weekly people were looking, 100 people were looking per week for property. We're now averaging in about 160, both for houses and for units. Okay, average is now about 150 since 2020. And we're going back at the start of last year, pre-COVID, and then COVID hit, the lockdowns hit. And then here's the latest lockdown where we are today. And the demand is still very steady and higher than it was even before lockdown, before COVID. And that's 2019. Okay, so with the amount of people coming in, you're now seeing a very high demand index for buyers. And then on top of that, this is a key thing we look at is sentiment. Okay, so compared to, and this comes from CommSec and Westpac, they do this and they base it on the amount of loans that people can get, and that equals to what we call consumer sentiment. It's the index they look at to see how many people are actually wanting to buy property. So compared to prior downturns, the recovery in consumer market today is the sharpest it's seen in their history since they started tracking this. So you combine all of that now, more people have come back in 1 year than 2 years of migration. They've all come back now looking to buy property, and the confidence and sentiment is much more optimistic. Even when it was back in, it's been more optimistic since, 2011 or since 2018, a little spike there. Okay, so you're combining those three now. Then on top of that, you combine all of that, and then now you've got, look at the loans that's been committed. Okay, this is the latest one since June this year. Okay, just look at how the commitments of loans for owner occupiers, investors, and people refinancing. That is extremely high. We're going back to 2003. Okay, you go prior to that, it's very low. Look at today's one, it's very high. So now you've got people coming in who are able to get loans and are being approved for loans. So what else are they going to do? They're going to buy property. Okay, they're going to buy property. And you can see here, watch this trend, guys. I look at this trend a lot. There's a very significant trend between house price growth and finance approvals. I've said this a lot in my other webinars. People always talk about interest rates. They talk about things like how much people are able to put deposits, all those things. But one clear indicator for me that shows nationally, look at the pattern between how a house price grows and how much housing approvals. Okay, so the light blue represents the growth in value and the dark blue represents the housing finance. And you could see there is a pattern. When finance goes down, property also goes down. When finance goes up, property goes up. Okay, that's just the nature of demand. If people, like in Australia, people love to buy properties whether or not they can get the loan. And if they can get the loan, they will buy. Okay, and you can see it here. So you've noticed that the light blue line always goes above the dark blue line. So here's 2021 where we are. Here's where we sit right now on that growth, and here's the finance approvals. Okay, so when people ask what's going to happen, I mean, you make a judgment for yourself. Okay, I can just show you these statistics and show you this, and you make that judgment and objection for yourself. Whether you believe that because people have this much finance, they're going to buy property, and do you believe that the prices will grow in comparison to where the finance is? Okay. Now, so what do we know about this last year? Despite low immigration, 500,000 people still came back to Australia. We know that buyer demand is still very strong. Finance approvals are at its highest ever, and it's continuing. Consumer sentiment is at the highest in the last decade, and there's only 0.1% of properties in negative equity in mortgage. Okay, so basically, we've figured out now that with all these data, is that the buyers are out there and they have been approved for these loans. The question now is, and this is the question that doesn't get said a lot in the media, I don't know why, but this is fundamentally property. It's about the supply. So we know there's demand, but what about supply? Well, let's look at this. Since 2016, both cities and regional markets have seen a decline in actual supply. Okay, so monthly total for sale listings, you can see here, the purple represents regional and the red represents capital cities, right? And they're both in decline, okay? And you can see it here as well. Look at the active listings in every state. The only area right now that has a positive in listings is the Northern Territory. Okay, and that's specifically Darwin. Every other state, including regional interstates, has seen a significant decline in listings. Okay, so now we ask ourselves, well, why has now this been, the biggest boom in 32 years? Well, this is the reason why. It's just too much demand and just way not enough supply. Okay, so that's the first wave of COVID. So, and you can see here, there's a big gap now in number of sales and number of listings. Okay, so the yellow is the sales and the blue is the listings, and it's widening even more. Okay, so a lot of people are wanting to buy, but there's just not enough to buy. Right, so we know now demand outweighs supply. Okay, and that is what's caused this boom. Okay, so the question I think everyone wants to know is, will this continue or has the market peaked? That's kind of the questions people ask. Well, let's look at the supply side right now. So currently we know there's a low supply of stock on the market. Now let's look at forecasted dwelling stock. Now this is run by KPMG Statistics. This was in July 2021. When they looked at approvals of new housing, they also looked at the new properties on listings in comparison to how much people have come in population. So look at their forecast. New South Wales and Victoria expected difference in dwelling stock from March 2020 to December 2023. Okay, most areas are negative. Okay, you're only seeing Queensland and Western Australia have a little bit of a positive in how much dwellings they're putting for sale. Everywhere else is seeing over that period very low stock demand, for a very low stock supply. Okay, so will it continue? Well, based on their forecast, they believe it will. Now, again, no one knows exactly. I can only show you these. And you can see here as well, guys, that number of homes for sale, combined capital cities is declining now. Ever since 2012, it's now at levels below that. Now you're going to see here, here's one thing to note. Every end of the year has a dip. Can you see that? There's a dip at every end of the year. That is the November, December kind of period where most people don't put properties for sale. So just remember, guys, that you're going to see these dips every year because in the last quarter of every year, not many people sell their properties. Okay, but overall, there is a declining amount of stock. Okay, so have a think for yourself, guys. When the question is, the question was put out there about supply, because at the end of the day, if you want to try to know what's going to happen after COVID, is we have to think about supply. So have a think. This is the question. Put yourself in the shoes of a seller. So imagine yourself, you have a property or you're living in a property. If you own that property or a property, would you want to sell it at a loss? Okay, this is fundamentally why properties in Australia really over a long term just grow, because no one wants to sell for a loss. You buy a property today for 600,000, 2 years later, do you want to sell it for 550? Or would you just wait? Most people wait. That's why there's no stock. Okay, most people, and then when they do sell their stock, they're either selling it on auction and getting such a high price because there's not enough competition, or the average is now 30 or 40 days when they put it on the market and it gets sold, which means they get the price that they want. So think about supply. Put yourself in a seller's position. Do they want to sell? We already know the fact that people aren't in mortgage arrears. Only 0.1% of properties are in arrears. So that's the question. And this is what I call supply. And you can see new listings fall as lockdown leads to seller trepidation, and that's throughout the country. Okay, so again, just make you think about the question is, will it continue? Well, have a think. Put yourself in a seller's position. Okay, so economists forecast. Let's look at KPMG, and then we look at Westpac Economics. What do they think when they combine all this together? Well, you can see KPMG pre-COVID and post-COVID. Okay, so light blue represents post-COVID, dark blue represents pre-COVID. So they're thinking, this is all the way till 2023 December. Okay, and then Westpac put their one out for 2023. Westpac believes that properties will drop around 2023. And that's only dropping really 6, 1 or 2%. And then KPMG is a lot more bullish, and they believe it's going to go up even more. Now, who do we believe? Well, to be honest, no one knows. Okay, no one actually knows what will happen. They can have their forecasts and all of this, but you don't really know. Again, I'm going to go back to this because I want to preface this again. Who knew that all of these were going to happen, that properties would just continue to go? Now, there's going to be periods, obviously there's going to be periods where it just doesn't go straight up, but there's going to be up and down periods. Okay, but to be very precise on your forecast, like for example, Westpac, honestly, you don't really know. Okay.
Well, if 2020 was anything to go by, John, Westpac got it completely wrong. They forecasted a 30% downturn in 2020, if you remember that. Yeah. So these numbers, my goodness, I mean, they've never been right historically anyway. So every time now, when you see it now, it's like, well, you've never been right anyway. So why should I take your word for it now?
Yeah, exactly.
Well,
So
that's true, right? I mean, like they've never historically been right. Every forecast I've ever seen that's come out of ANZ, Westpac, whatever it might be, has only been based on the sentiment on the moment in time in that time.
mm,
And then they go, well, it's a 30%, it's going to be a 30% fall, right? But it never had eventuated that way because there were other factors that somehow that they didn't take into consideration. You would think billion-dollar organizations like banks would have better forecasting, but every time, like in 2020, we were saying that the market was going to boom. And we're a medium-sized business that just started in August 2020. Big billion-dollar organizations were saying that the market was going to crash by 30%. At the same time, we were saying it was going to boom, and we were right, and they were wrong. So it doesn't really make sense anymore, if you ask me.
well, here's my take on it, and this is just my opinion, guys. Is numbers are they justify everything by numbers, but what you can't quantify is emotion. You can't quantify it because at the end of the day, people want to live somewhere and want to buy a property. And if they can get the loan from the bank, they will buy it, even if it's overpriced. Emotion is a very big thing on property ownership. Someone will pay, $100,000 or $200,000 more just to be in a suburb. They will pay, they'll spend an extra 50, 100,000 making their kitchen nice. So there's all these emotional factors that I don't believe that they take into consideration, and the resilience of property, because people are resilient and people just want to buy. So that's probably why. I've always in the belief that people want to buy property. It's just a matter of when do they want to buy, and can they get the loan? And if we're seeing, I always looked at the thing, Bruce, just look at loan approvals. There you can tell. Yeah.
Absolutely. Yeah, I agree with that. I think the loan approval one is probably the most telling because that loan approvals is what creates your demand.
Yeah. Yeah. So just go back to this, guys. Who knew? And like what Bruce says, you can't go off what, so all these sort of hype goes around it. Okay. So here's what I think now. It's the next wave of demand. So we know that demand came from currently the expats and all this. The question now is, if you believe that the supply side is going to be low, which I just showed you some forecast, is what about demand? Okay, so the demand for me is just look at how the Australia has projected, and this goes back to the ABS plus the Center of Population. The Center for Population is where the Australian government actually looks at these projections. So you've got to look at how they're looking at it as well. And they're showing here by 2023, they want to bring the levels of migration back to where it was. So back to the 200,000 people per year. So that's what they kind of want to get to. Obviously, it's all dependent on borders opening. Okay, so that's what it's dependent upon. So, but if you're asking what the next wave of demand is, I believe it's going to be from this section. Okay, so we have now, 2021? We've got about 2 years for the projection of the government to want this. And by the way, the government do want more migration to come in. Number one, income tax. The second thing is as well, guys, just remember that the highest form of government revenue in the last year has been from stamp duty tax. Okay, not even income tax. It's been stamp duty. So the more people buy property, the more money actually the government gets. So the more people come to Australia, the more income tax they get, the more revenue they get, and they get to spend it all on wonderful roads and trains and everything like that. So they do want to project this. And who holds the key to allowing immigration? Well, it's the government, obviously, to bring skilled migrants back to Australia. So that for me is the next kind of demand, the next wave of people wanting property. Okay, now I look at who are the migrants though. That's really the question. So regardless of COVID, just don't think about COVID for now. Just think about who are the actual people coming to Australia. These are the major migrant groups. Okay. Obviously, we've got English, the UK, but they've been here since the last 100 years or so. But the new migrant groups, India, China, New Zealand, Philippines, Vietnam. Okay, the new migrant groups is now we have to try to see how are they going to move in Australia when they come here. Okay, so you look at these locations. These are where the major migrants move within Sydney and Melbourne. Brisbane, not so much, but in particular Sydney and Melbourne. Northwest and southwest of Sydney, Melbourne, southeast, west, and north of Melbourne. And then you've now got regional locations. Okay, locations where major migrant groups currently live. Regional locations because the new migrations laws change where it allows migrants to come to Australia in a lot easier process, and there are more skilled, I think, migrant occupation lists within regional. So I think if you just look at these and you go back to this and say, this is the groups now coming to Australia, where are they actually wanting to live? Because remember, as a migrant, just now put your migrant cap on. If you're coming, let's just say from India, and you come to Australia, and the first thing you kind of do is, try to familiarize yourself with the community, you'll be attracted to a lot of other people in your same culture. And where are they living? You're influenced a lot by the people you hang out with as soon as you arrive in Australia. And these are the locations. Okay, so keep that as well in the back of your mind when I say what the future holds in terms of what's going to happen after COVID. Well, let's just think about where the new migrants, this new demand is going to come and where are they going to go to. Okay, so what we are learning right now, number one, the first wave, I hope I've justified it a little bit, that demand came from the expats, the first home buyers, and the upsizers. They were really the ones that triggered this kind of boom. Now, the second wave of demand, I believe, is new migrants coming back, and also now the investor market. Okay, because their loans, investor loans are now creeping up, whereas first home buyer loans are now creeping down. Okay, so these are the new sets of demand we're doing in an environment where there's still low supply. Okay, so here's one thing though. However, apart from the new migrants, what I want to show you guys is there is definitely a movement in location within Australia to regional. Okay, here's something that I want you guys to know, because here's something we want to look at very carefully now. Okay, so just look at this for a second, guys. As of last year, December, now the better stats is going to come out later because the new census is done. I hope you guys did the census. That, if you look at the last year in 2020, 43,000 net internal migration to regional Australia. That's the highest it's ever been in the history of movement into regional Australia. Okay, so this is something we now have to keep in mind. We know you may think the next wave of new migrants coming to Australia is probably going to focus on Sydney, Melbourne, maybe some regional. But internally, there is definitely a fundamental shift now in people moving. Okay, and coupled with that, stock is even lower in regional locations. Just have a look. This is 2021, so 2020 and then 2021. This was as of May this year. You look at here, this black line represents 2021. Okay, now you're looking at 60,000 this year, but you compare that to every other year since 2016, that the stock levels in regional were nearly close to 100,000. So you now have in regional locations, you now got a lot of people moving to regional for a sea change, a tree change, a lifestyle change. The fact that you can work from home is a big thing as well. And the stock levels are very low. Okay, so you're almost doubling what's happening in Australia in regional. Okay, now I just want to mention this though. Different regional areas aren't created equal. Okay, so when we're looking at regional locations, because we believe that investors right now should be looking at regional as a really good starting point for investment, especially over the next 2 or 3 years. But they're not created Okay. There's 4 types of regional. There's regional cities, there's connected lifestyle regions, then you've got industry service regions, and then heartland regions. So regional cities is like Geelong, for example. That's a regional city because it's got its own economy, it's got its own city. Places like the Gold Coast is a regional city. Okay. And then you've got connected lifestyle suburbs. Connected lifestyle suburbs is like Central Coast, Wollongong, lifestyle, coastal locations. They're growing. Even prior to COVID, they're the largest amount of people movement in regional. Okay, so regional cities and connected lifestyle regional locations. Okay, now what I want to look at now is, yes, we know that right now people are moving to regional, but we also want to know the millennials who are moving to regional. Because what you'll see is, yes, COVID allowed a lot of families and maybe downsizers to move to regional, but we also want to have a backbone here and saying it's the millennials we want to look at, because ultimately, if you're investing in regional, you want to also be sure that the age bracket from 25 to 35 are moving to that location. And you can see here, guys, that from 2011 to 2016, again, the next batch of these data comes out after the census, which will probably be at the end of this year. But the 2 locations that most millennials move to are either connected towns or coastal lifestyle locations. So these 2 locations, okay, right? And then now I want to show you guys the top locations that they're moving. Gold Coast, Newcastle, Sunshine Coast, Wollongong, Greater Geelong. I've highlighted these because these are these type of locations here. Connected lifestyle regions, okay? And you're seeing there that 233,000, 203,000, 294, 555,000 are moving to these locations. Again, you put yourself in their shoes. If you're going to go regional, you got to go to a place where there's lifestyle, So here are things we want to start tracking when we're talking about what should we do after COVID. Things to think about where we want to invest. Okay, now, couple of things we look at always when you go to regional, because regional is very different when you look at the data in comparison to capital cities. Capital cities is reliant heavily on population growth. It's reliant heavily on infrastructure. Okay, so we got to find that data for those locations. But when you go to regional, there are, what I put here, 3, 6, there are 9 kind of data points that we want to look at when we go to regional. So first thing is we need to understand high demand, low supply, because regional is based on supply levels. Okay, so just remember that it's not about a huge amount of population or a huge amount of infrastructure. It's about how constrained is the supply in that location. So a couple of things to look at. We look at making sure that 80% or above auction clearance rate. Now, I don't have time to go through all of this. 60 days below on the market, which means it sells below 60 days. Now, stock on the market is very important in regional. 1.5% or below stock. 30% are renters or below. It's a rising online interest, 3.5% rental yield, and 1% rental vacancy. So these are what I call regional data that you must stick by fundamentally if you're going to go to regional. Okay, now, couple of locations that have these: Gisborne, Geelong, Ballarat, Newcastle. Great examples that have these fundamentals. And you look at their 10-year growth. Okay, very healthy growth over 10 years. It goes from 7.5% all the way up to 12% in Newcastle, right? And that's per annum. Okay, so it grows per annum at these rates. Remember, if you go back to Bruce's webinar, a property doubles in 10 years with a 7% growth. These locations have been seeing that over the last 10 years. And these are regional locations with those fundamentals that I just went through. Okay, so things to stick by when you go into regional. Okay, now, regardless of location, guys, and we're talking about what to do after COVID, it's about value at the point of buying. Okay, here's something we want to emphasize a lot when we search types of properties. Because remember I said there's no market that is just a market. You got to know what suburb within the market and what type of property within that suburb, and then look at the value. As an example, this is just one of the properties we've negotiated before in the past. But what we look at is, if you buy you have to look at the comparable properties that are selling within that time frame. Okay, so both old properties and newer properties and inferior and superior properties. You got to look at the whole spectrum. And if you could see here, as an example, if you had bought this property, a 4-bed, 2-bath, 2-car for 710,000, yet a 4-bed, 2-bath, 2-car new property at 750, very old one for 699, and even older one, a 3-bedroom, sold for 726. So at the point of buy that you're coming in at the right price or even lower than what the market is selling for. This is how you kind of forget about anything else that's happened, COVID or anything else. You just got to get the point of buy at the right price when you start. Okay. And the reason I say that is, I'm going to go back to this graph, because you will always start at a 0%. So when you buy a property, you don't know whether it's grown or dropped, but you want to buy on value, and value represents comparable sales. So you have to assume, if you're getting it at comparable or below, your starting point is 0. Okay. Now, imagine you had bought that in 2016. You don't know how that property will move over the next 2, 3, 4 years. What you do know, though, is you've bought it at value or under. You have a more likely chance that in the next year it's going to be worth more than you bought it, because you have bought it at that value price. So you start at 0. However, it's going to go up, it's going to go down, go up and go down. Okay. It's just going to do this, right? So remember, wherever you buy, it's about the point of buying, and then you hold it for the long term. So you hold it until this period. Okay, so that's something you keep in mind. So
also, I want to also add something to what John just said as well, because I talked about this in the webinar that I ran last night. You would have all watched it, by the way. The normal webinar that you watched to sign up to this whole membership program. So during last night's version, I was talking about how there are completely 2 separate strategies depending on what market you're in. So if you're in a buyer's market versus if you're in a seller's market, the negotiation tactics and the strategies are completely different. And where most people are confused is that, number one, they don't actually understand that there's a difference between the two, and they utilize outdated methodologies to go in to try to negotiate a property or anything or something like that. One of the great things that I know John does, and I know Josh does extremely well, is understanding the differences between what market you're in and leveraging the right points to get the right type of value properties, right? And this is precisely the reason why a lot of you guys are members with us, is because in a market like we're in at the moment, it is a very dangerous market to be in if you're not surrounded by the right people who have access to the right research and the right data. Because at the moment, the market is absolutely doing things that nobody has expected. And it's gone up to the point where it has blown everyone's expectations, even our expectations, out of the water. So if someone's operating in the market at the moment and they don't have access to the right research, they don't actually have access to data points like you're witnessing today, and they're trying to go off and do things on their own, it's very likely that they're going to get burnt in this market. Highly, highly likely, because most people just don't know what they're doing. And so this whole program that we run, this whole membership program, is specifically designed so that you don't get burnt, and that you actually are operating with some sort of fundamental logic behind what's going on as best as possible.
Yeah, that's right. Because again, guys, no one can predict, a very short time frame what your property will do. One thing that is sure and it's been proven is, you give it enough time, your property is going to double, right? So you just make sure that when you buy that property, as soon as you buy, you know that you've got value when you buy, and you can only do that by comparing And you got to really have a deep dive into how you're actually looking at that property you're buying in comparison to the other properties, and how a valuer is going to look at it. Okay, so that's very important, regardless of where you are and where you're buying, and regardless what you're buying. It doesn't matter what you're buying. It doesn't matter if it's COVID, not COVID. You have to stick to these. Okay, now the other question is, what if my property can't get rented? Okay, so I just want to show you guys this, that just remember, guys, a 3% vacancy rate is what we call a balanced market. That means there's enough rental demand and there's enough properties. So it's just balanced. Anything lower than that is probably undersupplied. Anything under 1% is critically undersupplied, which means that people are just not being able to find rental properties. We're seeing that right now in a lot of locations, especially Gold Coast. But just look here, guys, at the start of COVID last year, May 2020, and we look at May 2021, the thing that's noticeable is it is dropping, okay? The only place that it's not dropping at the moment is Melbourne, but it's only increased ever so slightly. It increased in April this year, and as of May, a couple of months ago, it's now dropped again. But the vacancy rate nationally is about 1.8%. Now, this depends where you go, okay? So Melbourne is at 3.7, Brisbane 1.3, Sydney 2.9. Now, this is just vacancy rates, okay? So, however, to show you that we are actually undersupplied in rental, shows in June 2021 nationally, rental rates actually went up 6.6%. And you could see here, regional plus capital city. The only one that went down in rental price was Melbourne. Okay, everything else in rent went up. Okay, now the reason why Melbourne is at that place is because it's in a city market. Okay, so be careful, because you look at these markets, for example, Sydney, have very high vacancy rates, say in Parramatta, Strathfield, Auburn, Pennant Hills, and then Melbourne City. These locations have Melbourne City has 11% vacancy. Why? Because it relies heavily on migration and students. Okay, that's something we don't want to get into at this stage in the market. Okay, possibly in the future when students come back, it could come back again, and most likely it will. We just don't know when. But that's something to be cautioned of when you're talking about rent, is just be aware where you're buying in terms of rental, because I'm going back to that marathon runner analogy. You're looking at the long term, but what really counts in that term is, can you hold your properties? Can you withstand these fluctuations? Okay. And again, I put here rental location. When we look at the data, we look at things like 30% of people in the suburb are renters. So that means 70% are owner occupiers. And we look at vacancy rates. Okay, does the vacancy rate stack up in that suburb? So these are things you can pre-look at before investing. And the reason why I say 30% below renters on the market is because you know that there's always going to be a competitive rental location, because most people are owner occupiers. Okay, so we look at this data in terms of rental. Now, again, I just want to show you this, guys, that just remember that rental also fluctuates. Okay, it's not a steady vacancy rate. Okay, vacancies and rental prices go up and down, right? It can go from 3% down to 0.5%, and it will just keep going up and down. So the question is, what do we do about it? Well, first, here's what you need to know. Just know your outcomes. So regardless of COVID or anything else that happens, just know your outcomes, because rental is about expectation. One thing I always say is all properties in Australia can be rented. We fundamentally have an undersupply of properties to be rented anyway. Okay, it can be rented. The only question is your expectations. So how do you overcome that? Well, you need to be able to know what your scenarios are. Okay, so we always look at this when we look at properties, and if you're with a mentor, they can run through this with you. Just know that at the worst case scenario, the probable scenario, which is the current scenario, or the best case scenario, this is what your cash flow will be. So as an example, at the worst case scenario, if interest rates went up 5%, if your rental yield was 4, if vacancy rates went up 4%, if, for example, your strata went up another, $500, what does that actually look like as an investment for you? Okay, so when we go back to say, the marathon runner and you're in it for the long term, well, you are in it for long term, which means you need to hold your properties for the long term. Okay, so you have to ask yourself, at the worst case scenario, if any of these things happen, am I okay to pay $1,410 a year? Okay, so you need to be able to understand that. And that's how you kind of overcome when people say, what if my place can't get rented? Well, it can get rented. You just need to know what the outcome will be for you at the worst case. And if $1,400 a year, you can cover that, then you should hold your property. It's not a bad property to have, because it's going to go up and down. It will fluctuate. Okay. So let's go back to this point. Again, I'm going to go back to the, going back to that marathon runner type of thing. So just remember, guys, that we're looking now at what the future of COVID will be, but I hope I'm trying to help you understand that what you want to do is build your portfolio, just like a marathon runner goes through a very long journey. And the key is hold on to those properties, know your outcome in each of those properties at the worst case scenario. But I will say this, what to look out for, okay? And things that are probably going to happen over the next, 1 or 2 years. Number one, construction costs are going to go up. Okay, that's one thing that's going to happen. We're already seeing it now. And established properties are selling at record highs. The reason for that is the established property market, relative to the new housing market, is still very much undersupplied, which is why a lot of people go to auction, because they know they can get higher than what they expect. So we're at actually a period right now where construction costs are going up, which means properties will also go up, and established properties are also going up. So what does that mean for you? A lot of people say, well, I should wait until the property market cools and goes down. Well, if you're going off what's about to happen, which is costs are going up, established properties are going up, and sellers aren't selling, it's probably going to be even harder for people to get in the market 2 years from now. Okay, because remember, guys, regardless of when you buy, it's not about trying to time when you buy. It's not about trying to think that property markets is probably going to drop 3 years from now. It's you're going to buy on the value at the time that you buy. Okay, so just remember that. Right, so I'm nearly finished, guys. So what should we do from here? Okay, first point, I keep saying this, have that marathon mindset, everyone. Don't give up when the going gets tough, rain or shine. Marathon runners still keep going, rain or shine. Things are going to go up and down. Things are going to get tough. You might have to drop your rent $100 a week, in the next 5 years. You don't know. You just have to be ready for it. Work on increasing your endurance. What that means is work on increasing your rhythm of buying. Okay, your endurance to buy. Don't get sort of sucked into all that noise out there. Okay, that's endurance, mental endurance to keep you on your goals. Your goals will actually keep you on track here. Okay, the other thing is pace yourself. This is not a sprint. Okay, it's not a sprint. You're going to go step by step. You're going to evaluate as you go along, and then you're going to keep building as you go along. And like everything, ask for a helping hand if you need it. Okay, marathon runners during their race ask for drinks. They get drinks and help them keep going to the next kilometer or to the next 5 kilometers. That's what you guys also need to do. Okay, and that's the things we do is push you to that next 5 kilometers, push you to that next push you to the next property. Okay, so again, now I'm going to put this as well, guys, because this is a little bit of what you can do if you're thinking. I know maybe some of you are expecting me to say you should go to this location, or you should look at this location or this type of property in today's market. I don't look at that. I look at every market and every region has its own benefits. Why can't you just go look at all of them and look at an entire portfolio and get in each location? As an example, this is a good portfolio to have. A good one would be, how about focus on a Sydney regional, land with a house on it? Knowing that the fact that people are moving to regional locations, find the areas that have those fundamentals, and you're buying on value when you buy a Sydney regional house. Then you work towards your next property. Your next property could be Southeast Melbourne, for example, where you know that the new migrants are coming in, and in 2 or 3 years, these are the locations that they're going to be looking at to buy properties. Your third property could be a cash flow property. That's when you sit down and say, okay, now I've got these 2 properties. What should I do now to get my cash flow going? Because remember, a cash flow property is going to help you hold your portfolio. That could potentially be in Brisbane. Okay, what type of property? That's what we look at. And then maybe your fourth property is an apartment in Gold Coast, which is a lifestyle property, which we also know that people are also moving for lifestyle. So there's no one area that you want to go to specifically. Again, I just want to bring it down. Focus on what's important is holding your properties and having a diversification of your properties. Regional, city, apartment, cash flow property in Brisbane, each location. Okay. So number 2, again, I'd say know your worst case scenario, guys. Set buffers in your savings for this scenario. Okay. And the biggest thing I say for every successful investor, regardless of COVID or anything else, it's just focus on improving. Have a goal of saving more every year. Be in search for that better job opportunity that gives you better income, which will allow you to get more borrowing. And don't get distracted by outside noise, because we're going to go back to that map. Those people who were able to build 4 properties in 1996, guess what? They're probably sitting right now nearly retired. Okay, don't get distracted. Okay, and my last point, guys, COVID will pass. Long-term decisions aren't based on short-term events. Okay, we are in this on the long term. All of these little things happen as a short-term event. Okay, as long as you stick to some fundamentals when you buy the property, how to hold the property, and then focus on improvement of yourself, getting more savings, getting more income, getting better borrowing capacity, and then focus on building and don't get distracted. Thanks, guys. I hope this helped.
Yeah, John, that was an amazing presentation. So look, what we're going to do now is, John, you'll finish your presentation, right?
Yes.
Yeah. So if we can just go back to our not this, like, so just stop the screen share.
Sure.
Yep, that's perfect. And what we're going to do now is going to move into a bit of a question and answer session. So there hasn't really been a lot of questions asked during the presentation itself. So I'm hoping that we're going to get a bit more activity and a little bit more questions now. So if you do have a questions, please pop it in. And what we're going to do is going to spend maybe the next 15-20 minutes or so, or however long you guys want to hang around for. Really, it's a casual evening anyway, and answer some of your questions. I know you probably do have some questions you want to ask, so please feel free to ask whatever you like. Whether it has anything to do with the presentation today, don't worry about it. Just ask whatever question you want to ask us. John and I will hang back and do our best to answer some of your questions. I do want to add one extra bit of information that into whatever John just presented, which is that one thing that wasn't really mentioned around, why our markets has been so resilient, right, over the COVID period, was because of the budget, right, John?
Yes.
I mean, in the middle of 2020, when the pandemic just hit, and there was newspaper articles saying that the market was going to crash 30%, and banks were predicting a market downturn of 30%. There was a overwhelming expectation that we were going to have people out on the streets. We were going to have people not being able to pay their rent anymore. And there were going to be thousands upon thousands of foreclosures on properties, right? And then what happened was that was all basically protected by the government. We had this budget that was released in 2020, which was the biggest budget we've ever seen since World War II. And the government just pulled all stops and dumped everything they could onto the economy. We saw things like small business loans, JobKeeper, JobSeeker, the home builder grants, stamp duty concessions, tax credits, you name it. Like the government threw everything they possibly could at every single sector of the economy to actually prop up our economy so that it wouldn't fail. Then on top of that, all the banks came to the party and offered mortgage deferrals. So the reality of people losing their jobs, unemployment rates going to 15%, people out on the streets, that reality never eventuated. And then on top of that, we also had, maybe not today, but back, I guess in the last 12 months, we've had a pretty good response to the pandemic. If you remember, Sydney was pretty much an open economy for the past 12 months, up until the most current lockdown. We've kind of effed things up in the past couple of weeks, but before that, it was amazing. We were like the lucky country, right? And that added an additional sense of optimism into the market as well. So, if you're wondering why our markets have fared so well, it's because comparatively to other countries, we've done a pretty good job at managing our economy and managing the coronavirus all at the same time, right? And this lockdown that we're currently in, I think most people have already accepted the fact that we're not going to get out of this by going down to 0 case numbers. Our only pathway out now is getting to 80% vaccination rate. And according to the government, we're going to get there in November. So as soon as our vaccination rates reach between 70 to 80%, our economy is going to start to open back up again. And the COVID-19 is going to be something we're just going to have to live with, just like the flu or any other common, common virus out there, right? And that will just be the reality moving forward. So I don't expect that the current lockdown is going to have much of an impact or even a dent into anything, to the property market or anything like that moving forward for the long term anyway.
Yeah, look, I don't believe so either, because buyer demand is still strong and there's just no stock. There's no actually things selling, but people are still able to get loans. And there's people currently with approvals that haven't even got a property yet. So yeah, I mean, definitely, I agree with you. It's definitely, the government did definitely support and prop up a lot of the first home buyer market last year, giving those grants and helping people with no stamp, exemption in stamp duty. That definitely was a big trigger for people to go into the market. But that's also dying off now, And what we're seeing now is it's the upsizer market now and the investor market now trying to come in. Okay, so there's always going to be a change in that space.
Absolutely.
But when something goes out, another thing will replace it.
Yeah,
That's
exactly.
the property market.
Just remember, the market always moves in cycles, right?
Yeah.
Yeah. So look, I do have a question here. We've got a couple of questions, which is good. So we're going to kick off with Indy's question, Indy Lale. So he's got a question here. He said it's all about supply and demand. So the theory relies on the demand outstripping supply, right? So could this be reversed where supply significantly increases?
That depends on the locations that you go to. Now, when you go to greenfield, especially when you go to greenfield markets, Indy, how are you, Indy, by the way? Hope you're well. There's always going to be a period where that supply does outstrip the demand. Okay, especially when you're going to new suburbs, right? That's what happens. In regional locations, it doesn't tend to happen. That's why when we look at regional, it's always about the supply side that's very low, because supply doesn't normally outstrip demand in regional, because they don't get access to a whole heap of new land, or sellers there don't often sell enough. But when you go, for example, to areas like Melbourne or Sydney, and you're going out to locations where there's new suburbs being built, there's going to be a period where supply will outdo the demand, but it only is for a very short period, because what happens is once it's done, it gets absorbed very quickly, either by a renter or a buyer. And that's what has happened both in Sydney and Melbourne. If you look at those growing suburbs, which is why places like the northwest or southwest of Sydney are now at $1 million median house price, but they once started as high supply areas. When you want to go high supply, when there's areas that's going to be high supply, the best thing to do is try to get in there early at the beginning. Okay, so if you get there if you get there kind of towards the middle part, that's when the prices have gone up. And then if you get to the next cycle of that suburb, that's when the apartments come up. You really want to get to the beginning stages when that happens. So yes, Indy, you are right. The reverse can happen, but it doesn't. It's not like demand, where demand outstrips supply for a longer period. Okay, supply outstrips demand for a very short period. It's just a matter of when you get into that area.
Yeah, and the reason for that is there's a number of factors to it as well. Because as soon as when you have demand outstripping supply, what tends to happen is that whoever's selling the property, they kind of understand that that's going on in that location as well. So what you'll see actual the amount of properties coming on board start dropping as well, because no developer is going to keep on building in an area where they can't actually sell their properties. They'll actually hold stock off the market and they'll wait for the demand to catch up again. Otherwise, they're going to be just shooting themselves in the foot if they keep on releasing stock into that market where the supply is obviously outstripping the demand. So that tends to happen pretty quickly. So you might have a gap where it hasn't really caught up yet, and then you've got a period of high vacancy. But what we tend to find is that high vacancy gets absorbed pretty quickly, because pretty much things stop, construction stops, selling kind of stops, and it just waits for the market to kind of catch up to that. That tends to what happens in most high supply locations. You'll notice that construction will slow down as well. I've got another question here. Christine Park, so she's had a bit of resolution issues, and she wasn't able to see some of the numbers and statistics. And she's asking if we're able to distribute the presentation to the audience. So we don't actually do that as a standard practice. We don't actually send out the hard copies of our presentations. But Christine, what will happen is that this entire recording is going to be something that you can go back and look at again. The reason why the resolution is low at the moment is because this is a live stream. So in a live stream, the resolution is going to be lower than normal, but later on, when you go back and watch it, it's not a live stream anymore, it becomes a recording. And in the recording, you'll be able to watch the proper resolution version of it, and the numbers should actually all show properly. Okay, so you can go back and watch the recording, no problems at all. So next question I've got here is by, again, another great question by Indy. So thanks again, Indy. So can property prices be sustained versus income levels which haven't grown at the same pace? Which is a great question.
Yeah, look, this is an opinion-based question now, Indy, because I can only base it on my opinion. Now, for example, let's just think about Sydney. And I'm going to go back to this. Again, put yourself in a seller's position. Are you going to sell for less than what you bought it for? You buy a property and just say you buy any property for $1 million. If you don't need to sell it for under $1 million, why would you want to sell it? Okay, so the question, and I've been asked this before, is can property prices in 10 years be worth 2 million in Sydney, for example? Well, my rebuttal to this is, did you know it was going to be worth 1.4 million today? Like, if we go back, let's say even 15 years ago, and you told someone 15 years ago that in Sydney a median house price is nearly $1.5 million, they probably think you were crazy. Now, what could happen though, Indy, is this is what I think was going to happen. I think property prices will continue because people aren't willing to sell at a loss. That's the thing. People aren't willing to help other people and say, oh, I'll sell this to you for half the price. They won't. Fundamentally, they want to make a gain. And also the new stock on the market, developers, they also want to make a gain. So you've got people who own property or who are selling property that want to make a gain. What can happen now is the wage growth is going to be significantly in proportion towards, I believe, the new skilled migrants. So just remember, Indy, that a new migrant now, especially in Sydney and Melbourne, are averaging nearly $100,000 to $150,000 income as soon as they arrive in Australia. okay? And they're normally a couple. So two of them, like a family. And each of them is a family household there is probably needs 300,000 a year. They will be the next wave of people who can afford or even get a loan for these properties. What's going to happen to those people that can't afford? And it's happened throughout history of Australia, India. Anything close to the city back then, all those people who can't afford the city, what happens? They have to move out. That's how urban sprawl happens. It gets cheaper and cheaper, and then people have to move. They have to move. They have to move. So the wage growth for people who can't afford, their only option is to move, or they just stay a renter for the rest of their life. Because, example, you look at areas like London, Manhattan, New York. People don't buy properties there. They just rent because it's too expensive. It's become a rental property. It's a matter of fact, Bruce and Indy, that in 1970, 61% of people in Australia in 1971 were homeowners. Today, we're sitting at 40%. So home ownership in Australia is declining. Okay, that's a fact. People aren't able to afford properties. So there's people aren't owning properties yet. Property prices at the same time in that period have 10, 20 times the value. So yes, people are going to be left out and having to rent, but those people who are low wages or can't afford it, they're going to have to move. And that's been happening throughout Australia. And the ones who take over, I believe, are going to be the new migrants that come to Australia, because they start off on a high base. That's
Well,
what I
John,
think.
John, if you ask me, and indeed, this is another way to answer your question as well. You would think wage growth would affect property price growth, right? It makes logical sense when you think about it. How much does someone earn? Therefore, that should kind of dictate what the market should sell a property for. But that kind of is not really the case, right? Because the fact of the matter is that there's too many rich people to drive the market. There's just too many. And the other thing as well is that people kind of get used to the fact that they can't afford, and they just accept it. And the reality of a market being a renter-only market sets into a population as the market becomes more and more expensive. So there's the expectation that I earn this much money, therefore I have to be a homeowner, kind of just gets phased out after like a generation, because that's just not the reality anymore. And people just accept that as a fact now. You don't even have to go to markets like London or New York to see that. It's already happening in Sydney today, right now. Half of Sydney is a renter's market, and will just continue to be a renter's market forever. And I'm going to tell you right now that within the next 10 years, pretty much all of metropolitan Sydney is going to be exclusively a renter's market for the average income earner. The average income earner will not be able to buy a property in Sydney anymore. Even if you go like 50 kilometers out, that it would be completely unaffordable. They'd have to literally go 80 to 100 kilometers out to get something affordable. And that's happening. That's going to happen a lot sooner than anybody expects. So the new people that are graduating from university who are getting paid 60, 70K a year in income, they're just going to live in a reality where home ownership just becomes a pipe dream. And the only way for these guys to become homeowners is if they have some sort of inheritance from their family who got in during the lucky times, or if they somehow became millionaires and mega rich and they were self-made. And if they don't fall into those two categories, then that's it. It's game over. They're just going to be rented for the rest of their life, and that's how the markets are going to evolve over time. And if they really want to become homeowners, they'll just have to go 100 kilometers out and buy something. Even then it will be fairly expensive, because today, if you go 80 kilometers out of Sydney and you buy a house, you're still paying 700,000, aren't you, John? It's not even like 400,000 or 500,000 anymore. You're paying $700,000, 80 kilometers out of Sydney today, in today's market. So logically, you'd think that would make sense, but somehow it just doesn't turn out that way. And that's what I've noticed anyway.
Yeah, it doesn't turn out that way because no one wants to sell at a cheap price.
Exactly.
No one wants to sell.
And the other thing as well, John, is that, a lot of people say, well, when is it going to stop? Like, how can the market sustain this forever and forever and forever? And look, my opinion on this topic is that there's got to be something catastrophic to happen in the market for the market to kind of reset, right? So I'm talking things like World War III or a major reset in the world economy. Like the entire world economy just collapsed for some reason. And we went through things like the GFC and the coronavirus, and that didn't even make a dent into our market. In fact, it pushed it up even more, right? So I really can't tell you what's going to happen for the market to kind of stop doing this. It'll have to be something that is beyond anyone's wildest imagination to occur.
Here's my opinion, Bruce, and anyone else listening. For this to stop, banks have to stop lending.
Yeah, that's it. Yeah.
Banks have to stop lending to people. That's the only way it can stop. Because if people get access to money, they will buy. If they don't get access, then they'll stop. And banks aren't in the business of stopping loans because that's how they make the most money.
That's true. That's true. Yeah. The banks, it's all in the power of the banks.
All in the power of the banks. And because we're such a centralized banking system with a monopoly of 4 or 5 banks that literally control the market, if people can get those loans, people will buy. And to your point, Bruce, how's it going to catastrophically stop? If banks stop giving people the money, then they obviously
they're never going to do that, because imagine the uproar that will happen if they actually did that.
Yeah.
So another question here. So thanks, Indy, for a great question. We were pretty passionate to answer that one. Mitch, and if the prices were continue to grow, wouldn't the future look even more daunting? Yeah, I think we've already answered the question. Absolutely, it will. We absolutely answered the question. So his question was, wouldn't the future look even more daunting where the Sydney could hit a $3 million median in the next 10 to 20 years?
It could. And look, and that's unfortunate for our next generation. So
absolutely.
You look now about what the government's trying to do, trying to come up with affordable housing options. At the end of the day, if the government really wanted to help, and this is my opinion, they should just abolish stamp duty. That's a tax that doesn't even go to a property. You're paying 5% of the property price to a tax. If they really, really want to help, but that's not going to be abolished. So what they're trying to figure out is, how do we get people affordable houses? Now they're thinking of co-living options. They're thinking of, different things like share houses. That's their way of thinking, but it doesn't change the price of the property. Yeah.
Yeah. You would think that the government would actually want to help the average Joe get into the market. Unfortunately, most of their policies are in conflict of that. They want to incentivize people to, not be on the welfare system. So if you're not going to be on the welfare system, what do you have to do? You have to build up a property portfolio. You have to become financially free yourself so you don't rely on the welfare system. The government wants you to do that. That's why they have these things like negative gearing, tax credits and concessions, stamp duty discounts. They actively incentivize the construction industry to build more as well. That's never going to stop, because that's a key cornerstone of our entire economy. So the government says they will say things publicly to say, we're doing this, we're doing that to gain votes. But what really goes on behind the scenes is the complete opposite. Every time, it's happened time and time again.
Yeah, you're right, Bruce. Construction industry, guys, is one of, or if not the second largest employer in Australia. Construction, it employs so many people, plumbers, all our tradies. It employs all of them. And then it trickles down to, when you buy a new property, you need accountants, you need lawyers, you need all of these. It employs so many people. So construction is like the lifeblood of the Australian economy. They need to continue to build. So why would they stop that?
Got another great question here by Vicky Poon, which is, should we be waiting till there is less demand and more supply before investing? What's your take on that one?
Yeah, well, less. What do you say? Less demand, more supply.
Less demand, more supply. Yeah.
Yeah. Look, I always say to investors, try not to time this market, because it's difficult to time. There's that saying, and I always stick by it, is it's not about timing the market, it's time in the market. The best time to buy was yesterday. The next best time is when you're ready. Whenever you are financially ready, able to get the loan, the key is you are, going back to my presentation, you at the point of the buy, you're buying at value, regardless when you buy. Okay, just remember that Australian property market has never dropped 20 or 30%. At least in most locations. Maybe some few suburbs have done it, but if you're waiting until a lot of supply come and there's less demand, unfortunately, again, I always say demand is actually still very strong, and I still feel
Even in a low demand market, demand is still strong, isn't it?
even in a low demand market,
Yeah,
it's still
yeah,
strong.
yeah.
You know, again, it's about the only way you can stop demand is by stopping giving loans.
Yeah.
Just what APRA did back in 2017, 2018, when they put a little bit of the handbrakes on loans. That's when you saw demand drop. But then again, that's a bit of a double-edged sword, because they've all when APRA intervenes, it also makes it harder for you to get a loan.
That's right. That's right. Yeah, that does. You've got to keep that in mind as well. And Vicky, the other way I'm going to answer your question is that even if you do wait for demand to drop, let's just say demand's really high right now, and then 3 or 4 years later, demand drops. 3 or 4 years later, yes, you could wait for that point, but the price you pay for that property will be a lot more expensive than what you would pay for today in a low supply environment anyway. So yes, you could wait, but there's a cost consideration. There's an opportunity cost you got to consider between now and then as well.
Yeah.
Yeah. I think I've got my last question here. There doesn't seem to be any more questions, so we'll make this the last one. It's by Mitch Zhu. So thank you for the great comment. He said, awesome presentation, lots of wisdom. So thank you for that. The question is, hypothetically, if the property market were to truly crash, what do you think would be the combination of factors that could lead to this and would make it remotely possible? I think we've already answered this kind of, haven't we?
Yeah, well, I can answer it again. Like Mitch, in my belief, property in Australia is always about finance. And if the financial system, somehow the banks or whatever, decided not to give anyone loans, then it would really fundamentally crash, because no one can buy. No one has $1 million in cash to buy a property. You know, maybe a few do, but hardly anyone does. It's reliant on getting the loan. And just hypothetically, Mitch, what happens if your property all of a sudden did crash? All of a sudden, it's now worth zero on paper. It's $1 million, now it's worth zero, right? The question is, do you still owe the bank the loan? For some reason, it crashed and the whole bank is, do you still owe them a loan? The other thing to that is, if it did crash, you're still continuously getting rent. If no one buys property and banks aren't loaning, what are they going to do? They still need a place to live. That will have competition on rent. Your rents will skyrocket because there's no people aren't buying anymore. They can only rent. So just the fundamentals is, property is something that people need to live, whether they're buyers or renters. If you're an investor, either way, your property is either going to grow or your rental's going to grow. One or the other.
One thing that we do want to watch out for as investors is that what John said in terms of the banks controlling the growth, the market growth in property is actually real. Banks have the biggest power over how the market goes, and banks have the power to push the market and skyrocket the market, to slow it down or bring it to a complete halt. Banks have the power to do that. So one thing that we as investors, and even as a company, that we really watching out for is, over the next couple of years, is seeing how banks are going to react to this current boom. Because there is a possibility that the banks, through APRA, may actually reintroduce some tightening restrictions on lending as well. Now, if they do that over the next 1 or 2 years, it will have an effect to slow the market down. And that could very well happen if this current boom doesn't sustain, that it just keeps on going and going and going. It is probably going to get to a point where the banks have to artificially intervene to slow it down, because that's the only way it's going to slow. If APRA, if the government mandate the banks, just like what they did in 2018, and artificially introduce a credit crunch, that could be a possibility over the next couple of years.
Hmm.
Yeah.
Well, to add on to that, Bruce, they have said, the RBA or APRA have said they will intervene if they see double-digit growth for the next 2 or 3 years.
Yeah.
Right. They would have to come in at that point. But again, if they do come at that point, just remember, going back to that marathon runner, if they do that, you have to be able to keep going. Don't let that affect you too much. Your goal is your goal. You keep on track. You follow your savings plan. You follow the fundamentals, what your mentor has taught you. Just follow that. Those things will happen. We don't know when or how they're going to happen, but it will. So, and it will give a slowdown, and your property may drop in value, but over the next 10 or 15 years, it's not going to be like that.
Yeah, because that in itself is also going to be a temporary thing, right? The market always moves in cycles. So if the banks do end up restricting lending, that's going to only last for maybe 1 or 2 years maximum before they loosen it back up again. It's like a elastic band. They loosen up, tighten up, loosen up, tighten up, depending on the season of the market, right?
Yep.
And that's how it's always been, and that's how it will continue to be for the next 50 years. And so as investors, we really got to have to understand when things get loose, that's when we got to get in and get all of our ducks in a row, right? So now's the time to kind of like think about trying to get more of the bank's money, because that situation could change in a couple of years. We may not be able to get as much of the bank's money 3 or 4 years down the track, but we can now. So let's try to take advantage of that, and get in while we can. And when that market does come, at least we've already done all the hard work. We've done all the heavy lifting, and we're not there stuck in a market where we could have bought more when the opportunity was good, but now we're stuck and we can't do it anymore. Or again, the current market is a great market to do your refinances as well, and keep all the equity in your property, chuck it into an offset account, and leave it there as liquid capital. Because 2 years later, if the banks tighten up again, which means that you won't be able to get the same valuations you can today, all of that equity that you could have taken out gets kind of just disappears because you can't access it anymore. But if you locked it away today and it was sitting in an offset account all that time, that becomes your personalized bank.
Yeah.
You can access it whenever you want, even during a time where servicing may be very, very tough, because you've already done it. It doesn't affect you.
I will say this though, Bruce, there is an effect though when banks do tighten. It gives rise to the second tier banks.
That's true. Yeah, that's true.
It gives rise, because when in all markets, when a section of that banking industry tightens the lending, there's something that needs to replace it. And as an example, I'll tell you this guy, you guys can look it up. If the majority of Brisbane properties that are being settled are being done by not the 4 major banks. The market share in Brisbane in terms of loans right now is within the smaller banks, like your ING, but still owned by the bigger banks. Funny enough, a lot of them still own Rams, ING, all those ones. They're the majority shareholders now in terms of loans in Brisbane. Now the banks want to get that market share back. So it is that tightening and pulling, but just bear in mind, when that time comes and the major banks do that credit crunch, there's other banks that come up that actually take over that. That's what happens.
Yeah, precisely. Alrighty, I think we can wrap it up, John, and we should call it a night. We've answered all the questions, so it's been a great presentation, John. Thank you so much. Lots of wisdom, lots of valuable content as well. And so to our audience, thank you for tuning in. This will be a recording on our Facebook page, so you can always go back to it, watch it, do whatever you like. And I'll see you guys next time. So keep your eyes peeled for the next live event, because that will happen pretty soon as well. Okay, we've got lots of new stuff in store for you, so really excited to deliver that content to you.
Awesome.
All
Thanks,
right.
everyone. I hope you love this.
Have a great evening. See you. Bye.
Keep safe.
Bruce, are we? Sorry, I'm still here. Off live, right?
We're offline now. All good.
Yeah. Okay. I'm gonna pop my head up.